This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Look, Kawa out of the net right now, helping us here with the markets. What do you do at Dow 38,000 or UBS 1?
By and large, you're prepared for a consolidation given the strength of the run, but you prepare for higher. Really is our view. Our view coming into the year is that the surprise of the year, the thing that markets weren't expecting, would be that stocks had actually priced in a soft landing less than any other major asset class, and that stocks could rise, hit fresh record highs without getting much help from lower bond yields. So far, that's what happened. What we expect the next leg will be, possibly after some consolidation, is a more broadening out of that rally. So it's not just on the backs of the few. So far.
We got industrials coming out now. It's pretty shaky this morning. We didn't go. J&J did well, but others really pretty rocky morning. Do you subdivide in the day-to-day grind the tech growthy, profitable companies, cash flow companies like Microsoft from everybody else, or do you pull them together?
So our view for a while now has been that given just the extent of earnings outperformance you're getting from some of these names in tech, you can't be short them. You really cannot be short some of these cash generating machines, and we have overweight to technology and sector ETFs where we have that ability. So the short answer is yes. Still enjoy those. Still separate them. However, our view is more towards the broadening out. Want to have betting on a lot of different winners, whether that's in U.S. financials, whether that's in EM ex-China, whether that's in Japan. I really do think the story is the soft landing narrative is a boon to risk assets the world over.
Hey, Luke, we had that great run to end the year last year in kind of November, December. I don't recall earnings expanding that much during that period. Do we have a valuation risk here in the marketplace given that run we had?
Certainly at a valuation risk. You could also say that since the start of 2022, in theory, valuations have also improved mildly.
Right.
So you can play that off one way or another. Valuation is clearly not the best market timing tool. What it is very good at is kind of delineating how close to the money you might want your stop to be. At a very, very rich valuation, you might want to stop a little closer to the money. At something that has a little more valuation support, you might be a little more consistent to be able to bear out a weaker stretch.
So you mentioned emerging markets here. I've heard Japan mentioned. Not that Japan's an emerging market, but I've heard Japan mentioned more in the last 6 months than I have in the last 20 years. What's going on in Japan?
There's a lot of different elements here I think you can tie together. I think first, there's been a long story of trying to get corporate Japan to improve its shareholder return programs. That actually became serious. You actually really started to see more concrete steps around that, let's call it February, March of last year, and really started to see that ramp up and the market glom onto that. The second is Japan is probably the best levered play to nominal growth that you have out there. Really? It's predominantly export oriented, the earnings outlook, and it's also benefited from at the same time having the yen as weak as it is. The third element, but the third element is just definitely the fact that from an Asian perspective, if it's China or Japan, I think that rotational flow has been a very important story.
The heart of the matter is this debate over cash. We're deep into January, and everybody knows there's 6-8 trillion out there. I bring it up literally in every conversation because all of our listeners and viewers are looking at cash. Where's it going to go? Is there a UBS formula that says X percent of it goes back to deposits?
I would say just speaking generally, into longer duration assets. So this is something that even at the start of last year, because I would say the macro mood was a lot lower going to the start of last year. A big thing I was pounding the table on was reinvestment risk. You're not going to be able to get this yield on cash forever. Well, now that's actually more teed up. I think people are a lot more aware of what's coming down the pipe here. So it's effectively we are going to see some flows into whether it's longer duration or whether it's into the equity market. We would expect some more support on a flow basis as it becomes more apparent that cuts and the yield on cash is going down for good news reasons, a soft landing, falling inflation, rather than bad news reasons, a deteriorating economy.
All right, so Tom's been all over this Magnificent Seven. He's just been printing it in 2023. How about for the rest of us? I mean, I missed that trade. No surprise. My New Jersey municipals have done just fine, thank you. But where do I go now? I mean, do I chase those Magnificent Seven here?
I must have missed it when Tom left the triple levered all cash fund
Yes.
in favor of greener pastures.
Stealth move in the market.
Yeah, no, our view is things like U.S. midcaps, U.S. financials, EMX China. Those are some of the areas where you are seeing some more relative earnings support, valuations a heck of a lot supportive. So if you're looking at things that have been relative laggards, have a lot of catch-up potential, if the risk-on mood stays going, those are probably some of the spaces where we expect to see
obligatory Luke Kawa talk now. We got to go to hockey. Here, there's a great video out there, folks, of a really magnificent moment, and I lived it in that Michigan, when I played, was #1 in the nation. Without question, Red Berenson was the force there, and I had the privilege of talking to him as he said, Tom, you're not good enough. You're not going to escape from Michigan. Somebody else was, and it's one of the most famous goals in NCAA history. Your father and I went back and forth, Luke Kawa, the other day on one of the greatest goals the NCAA. He went around Jim Craig and put the orb in the net. And they lost to Wisconsin in the finals, but so what? That's Wisconsin. They're a bunch of Canadians. But what a joy growing up with Ben Kawa. What was that like? I mean, did he have you in the backyard doing sprints?
Not sprints, but man, they're still next to his dad just turned 100 this year.
Wow.
There's still an outdoor yard right in the park beside their place where he remembers skating as early as Halloween some years. And, now I think it's well into the new year before that thing freezes over. So make that what you will. But yeah, no, what a great guy, what a great coach. And it's been, great getting to banter with him on hockey over the years, as it is with you as well.
Okay, well, thanks so much. Luke Kawa with us, and good morning to Ben Kawa and Mr. Kawa Sr., 100 years old?
100 years.
Very cool. Carl Riccadonna is at BNP Paribas, and he knows that you read Blinder and Baumol at 14th edition at Princeton because that is gospel. And if you go to chapter 18, they talk about factors of production and other bow tie stuff involving productivity. Carl, productivity right now is a mystery. How does our mystery of productivity, marginal productivity theory, how does that fold into what I believe is a fully employed America?
Well, good morning, all, first of all. And as we think about the productivity numbers, it's really kind of a snow globe at the moment, post-pandemic,
like
because we've had wild swings in both directions. And so this is really a residual measure of economic performance. And I think we won't understand the productivity trend until we get to more steady state performance in the economy, which I'm optimistic that will be the case in 2024. But typically, as you have kind of labor scarcity episodes and high wage inflation, that creates the type of capital investment which does lead to higher productivity numbers. That being said, as we look at forward indicators of capital spending and whatnot, they don't look great. CapEx intentions look pretty poor for the economy at the moment. So there really is kind of a two-way narrative or two-way discussion that we'll have to filter through over the course of this year.
I love the Riccadonna snow globe analog. We will steal that and use that. Carl, if that is the case, we're a fully employed America, but Paul Sweeney and I are getting emails by the hour saying you guys are nuts. How can we have a 4%, sub 4% unemployment rate, and we're getting the emails we're getting? How does that happen?
Well, what's interesting, if we look at the last jobs report, there was some peculiar behavior in labor force participation. Had we not seen those moves, the unemployment rate would indeed be moving above 4%. So there's definitely a down vector on the labor market at the moment. It's been pretty steadily decelerating for the last 24 months, really. And so this may be creating some perceptions of economic weakness, but tying into today's events in New Hampshire, and as we think about the presidential cycle, there's weak economic sentiment from the public, but I think that over the course of this year, as it becomes more apparent that inflation has moderated, and it becomes more apparent that the labor market is still on a relatively healthy footing, this economic messaging, I think, is going to play favorably into incumbent politicians. Most importantly, the top of the ticket, the presidential races are very sensitive to economic conditions. Ronald Reagan said it in 1980, asking voters, "Are you better off than 4 years ago?" And Bill Clinton also honed in on that message in 92 with his unofficial campaign slogan of "It's the economy, stupid."
Exactly.
And I think "It's the economy" is going to resonate with voters, and maybe we saw kernels of that in the last Michigan sentiment survey as well.
Hey, Carl, what are you and the good people at BNP Paribas? What's your economic call here for 2024? Are you in the soft landing camp? Where are you guys?
It's some version of soft landing, so maybe we'll say soft-ish landing, because when you have the fastest and most aggressive Fed tightening campaign in 4 decades, just to think that comes in for a perfect landing, I think is maybe a little bit too optimistic. So we are cognizant that there will be some tensions here between still, very restrictive monetary policy, rising real rates in the economy, at the same time that the labor market and income trends are decelerating. So I think it will be a bumpier version of soft landing that plays out, but I think it will still fall short of what would be called a recession by the Business Cycle Dating Committee. So all in all, it looks to be a decent year ahead.
Hey, Carl, we just saw some earnings from some of the industrial companies, whether it's General Electric or 3M, a little bit of softness there. And we've seen softness in the manufacturing economy for many months now. But, boy, the consumer's hanging in there. What's your call on the consumer here for the year?
So the consumer's hanging in there, and just to take one step back, looking at those big industrials, right? As a macroeconomist puts on his equity strategist hat, right? We focus on the nominal GDP trend, and rather than margins, we look at inflation, right? They're measuring the same thing essentially. And when we think about the 2024 outlook, it will be a year where nominal GDP is slower than what we've seen in the recent years. Doesn't mean it's contracting, but it's definitely decelerating. And also, as inflation moderates, that's going to put pressure on corporate margins. So if you have slowing top-line growth and margin compression, that's a challenging year, or a challenging outlook for equities. Right. Now, the other side of that is that consumers are relatively healthy. We still have a tight labor market. We still have persistent wage pressures. So one way to think of that is it delays the Fed's rate cut plans. But wage pressures are still running at effectively 4%. 4.6% is measured by the Employment Cost Index. And this is, bad news for the Fed that wants to get quickly back to 2% inflation, but it's good news for the resilience of consumer activity.
Carl, I use a 10-year inflation-adjusted yield. The real yield, folks, is sort of my, it's like the Gilbert Chem set that Carl Riccadonna had years ago in the basement. And I look, Carl, the 10-year real yield, 1.80, to break out above 1.86 is new territory. Are you suggesting a sustained higher real yield is we're at 1.83 right now?
I think if we have a sustained higher real yield, that is going to put downward pressure on economic activity. And I like to think of it in Fed funds terms. So if we take the 5.5 Fed funds rate, we look what's happening in core inflation, pick your poison, whether you want to look at inflation expectations, core CPI, core PC deflator, which we'll get another look at this Friday. In that type of measure, it's telling you that the policy rate is moving higher and maybe too high for kind of a soft landing type of play out for the year. And so I think that means that there has to be a course correction. I don't think at the March meeting, but I think by the time the second quarter rolls around, we will have more confidence that the economy is moderating, the labor market is coming into better balance, inflation pressures have moved lower, so they still need to continue pushing on inflation with real rates well above our star, so a 2% real rate, but there will be a time for a recalibration around the middle of this year.
Well, we're our start freed on Tuesday, Carl, so we're cutting it short here. Thank you so much. Carl Riccadonna is with BNP Paribas. Right now, she did the Gabelli track. That's what we call it here. If you go to BC and then Fordham, we call that the Mario Gabelli track.
That's a good track.
And this is a really important conversation, folks, because she came off the derivatives desk at Deutsche Bank and at SocGen, which is owned European derivatives. SocGen invented the math, trading, gaining, and losing here on equity derivatives. Sylvia Jablonski joins us with Defiance this morning. Sylvia, let me just start out with Defiance ETFs. I love your cruise ETF. You know, it's been great. It's triple leveraged all cruise ETF.
Yep, love it.
But why did you guys choose not to do a Bitcoin ETF? Let's go right there.
Good morning, Tom. Thanks for having me. Well, you know, I think it's in ETFs. A lot of times, it's a first movers market, and there were a whole lot of first movers here. You know, so once you start hearing that BlackRock's in the game, you know, you had the grayscale people converting GBTC. It's just you have to make sound business decisions and know where you're going to win. But we probably would have, to be honest, if we had a chance of being first. Just wasn't in the cards for us.
we understand price volatility like in cruises during the pandemic. I'm sure your ETF was sport there on a day-to-day basis. What do you make of price volatility of BitDog? 49,000 when I stepped into it. Thank you, folks. That worked out. And we're enjoying sub 40,000 this morning. 38,961. What will be the ramifications of that price volatility for the billions in BitDog ETFs?
I like the BitDog ETFs. I think that a whole lot of people are going to buy the BitDog ETFs pretty soon when it falls to that, you know, 37,000, maybe even 36,000 level before it starts to rally up. I think this is kind of a classic sell the news thing. And, you know, the thing with these Bitcoin ETFs and Bitcoin in general, you have a lot of people that actually believe in the thesis of the product and that, you know, it will be digital gold and that there's a place for it in a portfolio. And if you see these institutions actually allocating that 1% to 2% to just give it a go and invest on that thesis, plus the people who just invest because they think a whole lot of people are going to buy it and the price is going to go up but have no conviction on it, you know, you can see that Bitcoin is going to get some tailwind here in the future because of these ETFs. If you look at the ETF filings, there are so many of them out there now for covered call strategies, for put right strategies and things like this. So, you know, just the sheer amount of volume of stuff that comes in and the amount of people that are willing to give it a try and buy it, I think will move the price.
It's inside baseball. Jablonski's all jargon. I mean, but can you imagine a covered right on BitDog? I can't imagine framing out a covered right to bring in premium on Bitcoin. I just can't go there.
But I know a lot of people are. And so,
you know, believe it or not, because we looked at this, that you'd be surprised. The actual kind of juice in this is less than it
now
is
we're talking.
On like a VIX product. It's really surprising. It's kind of surprisingly boring, to be honest. I don't know how it'll change over time, but there's not as much juice in there as you'd think.
And what's great about this is the way you learn about juice. You don't learn that like in CFA 101. You learn it at Marianne's on Comm Ave in Boston when you're going to Boston College.
So, Sylvia, I mean, I've just been blown away really over the last 10, 15 years in the growth of the ETF business. It's just been extraordinary. And the more you learn about it, the more sense it makes. And we have some good folks here at Bloomberg that are really following the ETF business. Where do we go next? What's the next area of growth for ETFs? Because the fund flows there are just extraordinary.
Yeah, the fund flows are back. I think, you know, post 2022, like everything else, ETFs have seen a recovery. You've seen, you know, the majority of inflows this year. And I think a lot of the kind of, you know, kitschy meme types of products have now been closed and kind of filtered out. And now what you have out there are the classic ETF products. You have some good thematics that invest in things like AI and, you know, supercomputing, things like that. We do a lot of that. But the next kind of hurrah for ETFs seems to be using options to do different things. So whether it's to generate income, you know, there's been a huge growth in covered call strategies. There's been a huge growth in put right strategies to generate income. You've seen a lot of flows there. And you've also seen, you know, different issuers doing creative things with leverage. So you're starting to see 4x daily rebalance products, single stock products. And I think that there's appetite there. I mean, billions of dollars have flown into it. So it's you know, hard to say there isn't. And I think using the option structure to generate income will be a big theme this year.
Sylvia, when I first started learning, and I think a lot of people learning about ETFs, it was the whole passive thing, the S&P 500 type of thing. And I got that jet would allow you to operate a really low cost structure type of wrapper here. But then you guys being the ETF industry, introduced active ETFs. And that's kind of where you lost me here. So is the cost advantage to an active ETF that much better than, walking down the street and getting a Fidelity mutual fund?
Well, it depends on the fund, right? I mean, mutual funds were sort of historically classically expensive. Some of them have cut their fees because of what ETFs have done. And it depends on the performance, right? I think on a lot of these active ETFs, if you're getting, 20, 40, 60% returns, you don't really care that you're paying 1%, which is arguably on the high side for ETFs, right? So it's all about what the ETF actually delivers. Yeah. And then ETFs are just, they're just better. I mean, they are a better mousetrap. You can buy and sell them all day long. You can arbitrage them. You can go to a market maker, get filled at NAV. I mean, they're just a better product.
Sylvia, a question off the mark, and this goes to SocGen. I spent a lot of time with SocGen Animals in London. There was a Cuban cigar bar on Wardour Street, which was basically the cafeteria for SocGen. This is before Sylvia's time. She's too young to remember this. But, at SocGen, you guys are pros at trying to figure out where the shadows are in leverage right now. Away from Defiance and your great work there, what do you worry about within the shadows of the derivative space right now? The leveraging up to notional. What's the shadow out there that concerns you?
I think if in terms of the structure of those products, I think that they've become kind of more stable and safe. I was actually at SocGen, shortly around the time that you had the Lehman crash and things like that. I was working on the swaps desk when all of that was going on. So that was, that was eye-opening, right? And people learned that you kind of have to have a third party holding the overnight collateral. You have to have, a lot of kind of like good Monte Carlo simulation before you take certain things on and swap and things like this. So I think that the risk standards are a lot higher. I think, having actual cash and physical funds at a third party matters. I worry more about the client. If you get a big market move and you have a Forex product, I mean, you can wipe out the fund in a day, right? But all of it is 24 hours. I mean, so I haven't actually seen that. I spent a lot of time at Direction, the 3X, place too. And even during COVID, when we had these massive moves, the company itself took the leverage point from 3 to 2 to kind of protect people from themselves, really. And the volatility and things like that. And so you hope companies do that. But that's the risk.
Sylvia, this has been hugely, hugely valuable. She's with Defiance ETF. Sylvia Jablonski with us. Joining us now, tech wizard who figured out YouTube decades ago, Gene Munster joins us, co-founder of Deepwater Asset Management. Gene, I've got like 8 ways to go. Let's start at 60,000 feet. I'm in the theme that if it ain't broke, don't fix it. The Magnificent Seven had a magnificent 2023. I just don't buy the idea it ends. Will it continue into this year and next?
For the year, I think it absolutely will. And what we're seeing is a gravitational pull when it comes to the AI opportunity with the Magnificent Seven, and also what I would call the Ordained 15, which are the private late-stage AI companies. And I think that's where all the traction is going to happen. I would say there's a Mag 7 on the public side. There's also going to be this Magnificent 7 or 10 on the private side. But yes, Tom, I think it's going to continue. I would caution and continue for the year. I would caution this earnings period is going to be a lot of intensity, a lot of focus from investors related to commentary about AI contribution in 2024. I think that is the A topic that's going to orbit around the Mag 7 for this earnings period. And I suspect that the commentary is going to be relatively muted, or the commentary will be, we expect some contribution. The good news, so I think that could cause a near-term pause in some of these stocks. I think the good news for a lot of these, for the companies, if you look at the estimates for the December quarter for the growth rates, and then for the full year of 2024, December 23 and 2024. Analysts aren't really expecting much contribution from AI. I think psychologically, it's a bigger topic than it is relative to the numbers. But I think that these companies are going to continue to do well. I do anticipate this earnings period to be mixed in terms of the stock reactions.
Early Gene Munster, Munster's so large. There's early Gene Munster, middle Gene Munster, and later Gene Munster. Early Gene Munster was 14 pages from Piper Jaffray, which came in at 4 p.m., and you had to read it by dinner or you couldn't focus. And in the back of it, he always had these brilliant sum of the parts analysis. Gene Munster, for the Magnificent Seven, for Apple and Microsoft in particular, what's the sum of the parts look like right now?
Well, the sum of the parts, it's ultimately, when you think about Apple, it's about services, it's about, you put all this together, I think it's better than a $3 trillion company. I think the iPhone business, today it's just over half of their total revenue. I think in aggregate that should trade at essentially a 35 multiple. I think that multiple is justified given, even though it doesn't grow much, I think it's justified because these devices have become substance to our life. We can't live without these, basically half the people in the US can't live without these devices. And so I think that you put this together, I think this is a $3+ trillion company. I think that there's a lot of uncertainty related to Apple at this time. I haven't recalled a time in Apple's history when there's been as much concern going into this to a quarter. There's concern about the iPhone demand. There's concern about some of the delays that they've had or taking some of that watch off the table because of the blood oxygen monitoring. And there's also some concerns related to how their App Store policies are changing, specifically related to steering and the impact on the App Store revenue. But I think that when you course these out, I think that this is a $3+ trillion company. And when it comes to Microsoft, from a sum of the parts, there's two basic parts to it. There's their cloud business. That business today, they have 22% market share. Microsoft in total is a $220 billion revenue company. It's going to grow about 15% this year. But as you think about an aggregate, their cloud business is worth, even though it's call it 15% of total revenue, given the profitability, it's 30+% of the valuation. The biggest lever when it comes to Microsoft over the next year in terms of the sum of the parts is related to what's going on with the upside and uptake with Microsoft, their Copilot and Office, that contribution. So they, of course, have raised the price, going from $15 to $30 a month, and that started back in November. There's about 350 million Office users. So the Office business today is about a $65 billion business of that 220 total in revenue. But you could build a case if a third of those people pay up for Copilot, which I think is conservative, that can increase revenue by 10%. And that's probably the biggest sum of the parts lever when it comes to Microsoft, is what the uptake is going to be. They haven't broken out what those numbers have been. As I mentioned, it started in November. All they've said is that they've had a positive reception from their early corporate beta testers with this Copilot. And I suspect this is going to be a hit product. It's going to help you compose emails, help you do PowerPoints.
Do my taxes.
Yeah, exactly.
Yeah, do taxes potentially. So I think
that was funny, Lisa. Yeah. You want to jump in here? What would you use Copilot for, Lisa Mateo?
Let's see. I know what my kids would use it for.
Book reports.
That's a threat.
They would help with the homework.
Book reports. Of course, we're talking to Gene Munster, managing partner and co-founder, Deepwater Asset Management. Hey, Gene, I think, that in 2023, not just in tech, but for the whole stock market, AI was such a driver of positive sentiment. And I think what a lot of investors who are pulling away and just saying, all right, let me just take a look at this AI story. And the question I hear most often is, how much of this spending across tech over the next several years for AI will be actually incremental to what was already kind of a base case for tech spending in general? Do you have an idea how that might look?
So yes, the answer is that it's a substantial amount, in the 20 to 30% range.
Wow.
Meta last week had some commentary about what their spend is going to be on GPUs. And if you look at what their baseline spend was before they announced that, it's a 30% increase in spend. There was this talk about pause in AI last summer. There was this letter that went around that bunch of people, including, ironically, Elon Musk signed. And there's been no pause, is that these companies continue to aggressively go after this. And I think that is one of the clearest signs how much investment is going on from these companies, that the AI substance is ultimately going to exceed the hype. It may take several years to get there, but yes, the infrastructure spend is remarkable, especially with the Magnificent Seven. And of course, that infrastructure spend helps a lot of companies, many companies, potentially most companies, to enable AI in their products in the years to come.
Hey, Gene, one of the things that I think some investors are waiting for when they think about AI is that defining IPO. Like maybe Google was a defining IPO for the search business. Facebook was the defining IPO for the social media business. And you mentioned some private companies. Do you see something like that in the next year or two? A company or a group of companies that say, wow, AI has really arrived as a standalone kind of investment opportunity?
Absolutely. I think that's going to be the next leading class. I think it's probably 2 to 3 years away, but I think that these companies that are AI first companies, when we look at the Magnificent Seven, I talked about the upside related to Copilot and Microsoft and saying that could add 10% to their revenue. Well, these companies that are AI pure plays, they're growing at 300% off small bases, but approaching more than $1 billion in revenue, some of them. And I think that these AI pure plays, there will be this moment. Ultimately, when you put it together at Deepwater, we think we are going to enter an AI bubble in the next 3 to 5 years. We don't think we're anything close to it right now. We put this in, we think we're in like 1995, and we still have 5 more years to go before this really escalates. But I think that's going to be one of those moments where it really gets some excitement in the market once we get some of these IPOs. And who are they? It could be OpenAI, Databricks is one, Hugging Face. Those are Midjourney. Those are kind of the 4 most obvious ones that would be public.
That's a secret world of Gene Munster there. Gene, the fact of the matter is, Mr. Nadella is firing on all cylinders. You mentioned Copilot and all the applications that we're seeing of actual money coming in, $20 a person, $10, $30 a person. And I'm enjoying a 38 multiple, and maybe my Munster guesstimate forward squeezes down to a 35 multiple. What do you do with a tech stock when all the good news is in, like in Microsoft right now?
Well, if your view is that all the good news is in, you probably sell it. And I think in the case of owning, that is a great way to build wealth, is to have people agree with you later. And if you there's generally a consensus that the good times are going to continue for these large companies. And so I think that if you have a view that maybe this is as good as it gets, that this is absolutely the time to sell, because you'll get multiple compression. I, of course, don't believe that that's the case. And I just want to put a little bit of perspective on that in terms of, how on earth I really strive to be level-headed when it comes to these tech trends and making sure that I'm not getting carried away and some of the overall hype on it. And when I think of AI, I'm in the camp that electricity is 100, the mobile phone's a 25 in terms of scale of importance, the internet's a 50, and I think AI is probably a 90. I think this is ultimately
really that big. Wow.
And if in fact that ends up playing out, then we really haven't seen. I'll give you another example, is that we were buying Meta over the last couple of years, and it's done well recently, and we debated internally about is this a stock that we should sell? It's had a good run. Let's take our money and go other places. But then we just thought more about the impact that AI is going to have in their business, and it just felt like this is one to continue to hold, and so that's what we're doing.
Single most important insight of the week. You just heard it from Gene at Munster with war wounds of selling too soon. And he said he has a winner in Facebook. Guess what? He and his team said, extend that. And that, Paul, you and I know, how much money have I left on the table? I'm in triple leveraged all cash. I'm leveraged up with a 15% gross, and I go, now lighten up. And I'm wrong every time.
Hey, Gene, I'm just trying to think of some headwinds here for the tech space. I mean, do I have to worry about Washington, D.C. here in terms of regulations more just broadly defined on tech and maybe even specific for AI? How are you guys framing that risk out?
Well, when it comes to AI, there's going to be more regulation. Of course, we've got that letter that I mentioned. Tim Cook has been, he hasn't said anything in his prepared commentary on their earnings calls in 2023 related to AI. He has made comments more recently outside of the earnings calls and said that regulation is important. He's mentioned that also in their Q&A. I think when you have a company like Apple inviting regulation in, I think it's probably something that is going to play out. As far as the impact on the business and how profound this growth can be, I don't think it's going to have an impact on that. I think that a lot of the regulation is going to come around things like watermarking related to images to try to help prevent deep fakes, and the use of AI for whether it's for malice behavior. But I don't think that I think that this aggressive investment cycle is ultimately going to continue. The broader topic beyond AI and regulation in Washington is something that has orbited obviously for years, and we have at the end of this month Meta and Snapchat and TikTok they're all going to be on Capitol Hill and talk about some of the latest issues related to some of the targeting that's going on those platforms. The simple answer is that regulation sounds bad, and really the substance of it hasn't played out. And it's a little bit hard for me to imagine why now is the time when this would start to have an impact.
Really generous time with us today. Gene Munster, thank you so much. Deepwater Asset Management there on your view of tech. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.